Many aspiring finance pros view private equity as the ultimate goal, and in particular chase after the shiniest names like Blackstone, Apollo, and KKR. But for those who work in the finance world, they know that the most prestigious firms aren't always the best ones to work for, and that finding a smaller firm you can stay at for longer is more lucrative in the long run. And so in today's video, I'm going to be explaining the differences between middle market and mega fund PE firms, and then at the end of the video, explain how you can choose between the two. Now, before getting started, if you're watching this because you're interested in breaking into private equity, you may want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything discussed in this video's description. Alright, with that said, let's go into an overview of middle market private equity. First off, for some context, there are 2 main ways to differentiate private equity firms from one another, and those are the size of the firm's funds and the size of their deals. Based on these criteria, there are 2 broad categories, middle market and mega funds. Middle market PE is a catch-all term for any fund that doesn't quite fit the mega fund PE category and can be further broken down into 3 different subcategories. At the bottom, we have lower middle market with individual fund sizes below 1 billion and deals under 100 million. Then core middle market with funds between 1 billion and 5 billion and deals between 100 million and 500 million. Then upper middle market with funds between 5 billion and 15 billion and deals between 500 million and 1 billion. And last but not least, mega funds with funds greater than 10 to 15 billion and deals at a minimum size of 1 billion. With that said, it's important to note that these lines are often blurred, especially for the right investment, and PE firms can invest much larger and smaller amounts regardless of their classification. In particular, upper middle market private equity funds occupy a unique and somewhat ambiguous space in the industry. They're often too large to focus on true middle market deals, but lack the sheer scale and resources of megafund PE firms. PE shops like Veritas Capital and Leonard Green operate in this kind of gray area, targeting deals that are often worth several $billion dollars, and they bridge the gap between middle market agility and megafund firepower. The larger upper middle market PE funds are also often courted by mega funds to participate in what are known as club deals because they know that they have the capital and expertise to play in the big leagues, with one example being Francisco Partners and TPG, who teamed up to acquire New Relic for $6.5 billion in 2023. And if there's one thing I want you to take away from this video, it's that the most common fallacy is that middle market deals are not as exciting or as profitable as the flashier, larger mega funds, because this is simply not true. Middle market deals typically offer more opportunities simply due to the sheer number of mid-sized companies available compared to large corporations. With a broader pool of potential targets, middle market firms in private equity can execute more deals, spreading risk to diversify their portfolios and gaining multiple avenues for value creation. In comparison, when a megafund private equity shop acquires a large company, they generally have limited opportunity to truly scale the business or improve operations from its existing position. Middle market companies usually have so much room for growth and expansion because they are generally not run as efficiently as large companies, so that leaves ample room for middle market PE firms to come in and create more value and gain potentially higher ROIs than their megafund counterparts. Alright, now next up, let's go into the mega funds. As a reminder, mega funds are PE shops with funds greater than 15 billion and deals at a minimum size of 1 billion, though again, these lines are often blurred because there are 2 camps of people when it comes to defining mega funds. The first group of people say that not only do mega funds need to have flagship funds greater than 15 billion, but should also have multiple strategies that have sizable investment vehicles, and this is the more traditional view of how to define a mega fund. For example, the 3 most recognizable mega funds, Blackstone, KKR, and Apollo, are all publicly traded and have strategies beyond private equity like real estate, credit, infrastructure, secondaries, and special situations. And as a fun fact, some of these strategies like credit or real estate have grown magnitudes larger than their PE arms in terms of assets under management. These firms also have offices and separate dedicated investment vehicles for different geographies, such as their independent European or Asian funds, which have generalist mandates that allow them to invest in all industries from consumer retail to software to industrials. The second group says that basically almost any PE shop with a flagship fund greater than $15 billion, period, should be called a mega fund. This would include firms like Thoma Bravo, which recently raised a monstrous $20 billion fund and only focuses on enterprise software and tech-enabled services buyouts, primarily in North America and a bit in Europe. Another example is CD&R, which has not historically been regarded as a mega fund, but recently raised $26 billion in 2023, which is the third largest in the world and larger than Blackstone, KKR, and Apollo. While Bain Capital, which has a variety of strategies and was more often thought of as a mega fund, is targeting only $10 billion for its latest fund. So as you can see, there probably is no right answer, but it does seem like the term mega fund is being used more loosely nowadays, and it's shifting more towards the second group of people, which means that mega funds can be public or private, can focus only on PE and in one industry, or have diversified strategies, and can be geographically focused or international. The most specific common characteristic across all mega funds is that their flagship buyout funds are generally massive with around $15 billion under management. And here is a list of the firms that fit this criteria and are generally what I consider as mega fund private equity firms. And you can also watch this video to see how I rank them against each other. Alright, now that you know what makes middle market and mega funds different, let's now talk about how you can choose between the two. What we're going to do is talk about the pros of working in middle market versus mega funds, and let's start with the middle market private equity firms. The first pro is faster career progression and more responsibility. Teams are typically smaller and leaner at middle market firms, and so you end up owning much more of the deal process earlier on in your career. And so instead of just running numbers or handling a narrow piece of the deal like you would at a mega fund, you're more likely to interface directly with management teams, contribute to investment decisions, and even lead key parts of transactions much earlier on in your career. Second is better work-life balance. Of course, when you're on a live deal, all bets are off no matter where you work. But in general, mega funds are known to be just meat-grinding sweatshops, especially at the junior level, while middle market firms are known to just have better cultures overall, just like at elite boutiques versus bulge bracket firms. Third is the likelihood for higher long-term earnings. While mega funds are flashier, most people burn out quickly, whereas if you find a middle market firm that you fit in well with, you'll end up staying there longer, and the longer you stay at one firm, the more you'll earn from carry and co-invest opportunities, which is more challenging to do at a mega fund given the high level of burnout. Next though, let's move on to mega funds, which have a lot of their own great advantages. First is the compensation at the junior level. Mega funds typically offer higher salaries and larger bonuses than middle market firms, which they can afford to do because of their larger deal sizes. But as discussed, you may burn out more quickly and could earn more in the long run at a middle market firm. Second is the chance to work on the world's largest and most complex deals. Given how much capital needs to be deployed, mega funds work on deals that require more sophisticated structuring, deeper industry expertise, and involve higher stakes. This also means working with top-tier banks, legal teams, and consultants, and while middle market firms still do meaningful deals, mega funds provide the opportunity to analyze and execute transactions at a global scale at times, shaping entire industries through capital deployment. Last but not least is the brand name, and let's face it, the prestige. If you work at Blackstone, KKR, or Apollo, then there is a chance that the girl or boy you're talking to at the bar or your grandma will know what that firm is. But more importantly, you'll gain access to elite exit opportunities such as top business schools or hedge funds, which are still possible from middle market firms, but certainly harder. In addition, you'll always be able to tap into a large and powerful alumni network that has been established for decades. Ultimately though, there's so much to consider, including a fund's strategy, returns, industry focus, culture, and a whole lot more. And at the end of the day, it's so hard getting any offer in private equity that the best offer is often just the one you can simply get. On that note, in order to break into private equity, you often need to first break into investment banking. And in case you're interested, I wanted to let you know that I recently launched a one-on-one mentorship program called the Banking Accelerator, where I help determined students, graduates, and early career professionals secure investment banking roles that can earn you over $150,000 in your first year on the job. Regardless of your school degree or past experience, my personal guarantee with this program is that if you don't secure a role in 180 days or less, my team and I will work with you for free until you succeed. And so if you're interested, feel free to check out the link for this in this video's description. In the next screen, you're gonna see a video about the largest PE firms in the world being ranked, which you can check out if you're interested. With that said, thank you so much as always for watching and hope to catch you in the next one.